At its peak, AMC was worth more than $28 billion. Shares hit a split-adjusted $600 amid feverish crowds of retail traders and Reddit-fueled defiance. But within 4 years, nearly $25 billion in value had vanished, leaving shareholders facing a 99% collapse. How did a century-old movie titan, once built on bold acquisitions and sky-high debt, become the centerpiece of a cultural and financial flashpoint? The first cracks began long before the cameras and the chaos arrived. In 2016, AMC set out to become the world's largest movie theater chain, embarking on a spree of acquisitions that reshaped the industry. The company paid $1.1 billion to buy Carmike Cinemas, instantly expanding its reach across smaller U.S. cities and rural markets. That same year, AMC struck a $1.2 billion deal for Odeon and UCI Cinemas Group, gaining a dominant position in the United Kingdom and Europe. Just months later, it added the Nordic Cinema Group for nearly $929 million, planting AMC's flag across Scandinavia. Each purchase was financed with borrowed money, stacking new loans and bonds on top of the company's existing obligations. The strategy was simple: scale up, outpace rivals, and lock in the power that came with being the biggest. AMC's multiplex model, offering multiple screens, luxury recliners, and premium amenities, became its calling card, and the company poured capital into upgrading theaters and rolling out new formats. By 2017, AMC operated more than 1,000 theaters and 11,000 screens worldwide, making it the undisputed giant of the cinema world. This relentless expansion came at a price. The company's debt load soared past $5 billion by 2019, with interest payments eating into thin profits. The pressure to fill seats and justify the ever-growing scale grew more intense, even as streaming competition and shifting audience habits began to threaten the traditional moviegoing experience. Still, AMC's leadership pressed forward, convinced that size and spectacle would guarantee survival. The company's global footprint was now vast, but its financial foundation was increasingly fragile, leaving little room for error if the winds turned against it. AMC's global reach masked a dangerous reality. The company's financial structure was stretched to its limits. By the end of 2019, AMC's debt had climbed past $5 billion, a burden that demanded hundreds of millions in annual interest payments. Each month, the company faced a mountain of fixed costs, leases, maintenance, payroll, regardless of how many tickets were sold. Even in strong box office years, profit margins remained razor-thin. But the industry was changing. Streaming giants like Netflix and Disney Plus were luring audiences away from theaters, releasing blockbuster films directly into homes. Studios began experimenting with shorter theatrical windows, eroding AMC's grip on exclusive first runs. Attendance figures, which once seemed unshakable, began to slip. In 2019, U.S. movie ticket sales fell to their lowest level in nearly a quarter century. To keep pace, AMC poured more money into luxury upgrades and premium experiences, hoping to draw crowds with reclining seats and IMAX screens. Yet every new investment added to the company's debt load. Behind the scenes, lenders tightened their grip, inserting strict covenants and demanding higher rates on each refinancing. The balance sheet grew heavier, while the safety net beneath it thinned. As 2020 approached, AMC's obligations were coming due. The company owed nearly $1.2 billion in principal payments over the next 3 years, with little cash on hand and no easy path to refinance at favorable terms. Analysts at Citi and Wedbush warned that the company's leverage ratio was among the worst in the industry. A single shock, an unexpected drop in box office, a delay in major releases, or a sudden economic downturn could send AMC spiraling into crisis. Theaters had always been a high fixed cost business, but now, with streaming on the rise and debt at record levels, AMC stood on a knife's edge, vulnerable to forces beyond its control. March 2020 brought the movie business to a standstill. Within days, AMC's 1,000 theaters went dark as the pandemic swept across the globe. The company's revenue, once measured in the billions, evaporated almost overnight. In the second quarter of 2020, box office receipts and concession sales collapsed by over 95% compared to the previous year. For a company built on constant foot traffic, The sudden silence was catastrophic. Fixed costs, though, kept piling up. AMC still owed hundreds of millions in rent, payroll, and maintenance, regardless of whether a single ticket was sold. With no money coming in, the company burned through nearly $1 billion in liquidity in a matter of months. Each week brought new bills, but no relief. By the end of June, cash reserves were dangerously low. Theaters sat empty while creditors, landlords, and employees waited for payments that could not be made. Wall Street's faith in AMC faded fast. Bankers began preparing for a possible bankruptcy, and distressed debt funds circled, eyeing a fire sale of assets. The sense of urgency was unmistakable. Without a dramatic infusion of cash, AMC would run out of money before the end of the summer. The world's largest movie chain now stood on the brink of insolvency, with no clear path to survival. Adam Aron faced a crisis that threatened to wipe out AMC overnight. With theaters closed and revenue gone, he picked up the phone and began a marathon of negotiations. Landlords owed more than $400 million in rent were first. Aron pressed for deferrals, arguing that empty buildings served no one. By July 2020, AMC had secured relief on about 3/4 of its leases, with repayment schedules stretching up to 2 years. Some landlords pushed back, demanding strict catch-up terms or threatening legal action, but most agreed to forbearance rather than risk permanent vacancies. The breathing room was temporary. Aron turned to Wall Street for emergency cash. Bankers pitched high-interest loans and convertible notes, demanding steep fees and security on AMC's most valuable assets. In June, hedge funds like Silver Lake and Mudrick Capital stepped in with $500 million in senior secured notes, carrying interest rates as high as 12%. Other deals proved even costlier. One debt for equity swap with Mudrick converted $100 million of debt at a 25% discount to market prices, handing over stock at a bargain. Negotiations with Apollo and Oaktree for another $200 million fell through, as confidence in AMC's survival waned. Every dollar raised came with strings attached, higher debt, tighter covenants, and mounting dilution risk for anyone still holding shares. Aron's team weighed asset sales and even considered bankruptcy, but each time squeezed out another lifeline. By the end of 2020, AMC had layered on $1.6 billion in new debt and deferrals, enough to survive the winter, but only if help arrived from somewhere else. On a chilly morning in January 2021, a new kind of movement began to take shape online. Reddit's Wall Street Bets forum, already buzzing from the GameStop frenzy, turned its attention to AMC, a company teetering on the edge. The posts were not just about profits or technical charts. Instead, they were filled with memes, rallying cries, and a sense of shared purpose. Users called themselves apes, borrowing the phrase "apes together strong" from the movie Planet of the Apes, and it quickly became more than a slogan. It was a declaration of unity and defiance. The language of the group was raw, irreverent, and deeply personal. "We like the stock" became a mantra, repeated in post after post. Members shared screenshots of their trades, some risking their savings, others putting in just a few dollars, but all insisting they would never sell. The enemy was clear: Wall Street hedge funds betting on AMC's collapse. The community cast these funds as suits, painting the battle as a fight between ordinary people and powerful institutions. Every day, new rituals took hold. Members posted diamond hands emojis to show their resolve, vowing not to fold under pressure. They celebrated each small price jump with gifts, inside jokes, and stories of hope. Some users chronicled their struggles, lost jobs, medical bills, dreams deferred, but found comfort in the group's encouragement. The promise was not just about making money. It was about belonging, about standing up to a system that felt rigged against them. As more people joined, the forum swelled with energy. Posts soared into the thousands, and hashtags like #AMCArmy and #SaveAMC trended across social media. The movement drew in those who had never traded a stock before, united by a sense that together they could tip the scales. The mood was electric, fueled by hope, rebellion, and a belief that, for once, the little guy might win. By late January 2021, the ranks of AMC apes had grown into a force Wall Street could not ignore. Trading screens lit up with a frenzy not seen in years. On January 27, 2021, AMC's share price exploded, surging from under $5 to over $20 in a matter of hours. Trading volume shattered records. Hundreds of millions of shares changed hands as retail traders, fueled by viral posts and hashtags, piled in. Wall Street hedge funds scrambled to cover short positions, amplifying the chaos. Each uptick sent new waves of buyers into the market, convinced they could force a short squeeze big enough to topple the suits. Brokers struggled to keep up. By midday, January 28, 2021, Robinhood and other platforms abruptly restricted buying of AMC shares, citing clearinghouse requirements and risk controls. Only selling was allowed. Outrage erupted across social media. Accusations of market manipulation and collusion with hedge funds trended for days, with hashtag Justice for AMC and hashtag Let Them Trade dominating Twitter. Congressional leaders called for hearings. The battle lines, retail versus Wall Street, were now a national spectacle. As the price soared, AMC's market cap briefly touched $28 billion, a figure that stunned even seasoned traders. Media outlets ran live updates. Financial analysts tried to explain the mechanics of gamma squeezes and margin calls to a public hungry for drama. Celebrities joined the fray. Mark Cuban tweeted support for the apes, while YouTubers live-streamed their trades and urged viewers to hold the line. In Discord servers and Reddit threads, users tracked every halt, every tick, every rumor. The sense of collective action reached a fever pitch. Behind the scenes, AMC's leadership watched as their battered company became the center of a cultural firestorm. The volatility gave the company a rare opening to raise desperately needed cash at prices no one thought possible just weeks before. For a brief moment, the world's largest theater chain was not just a business fighting for survival, but the beating heart of a financial revolution. As the trading day closed, the price hovered near its highs, but the system itself seemed stretched to the breaking point. As AMC's share price rocketed into the stratosphere, Adam Aron wasted no time. In late January 2021, the company unloaded more than 60 million new shares into the market, raising $300 million in a matter of days. Just 5 months later, another 43 million shares were sold, bringing in an additional $230 million. Each offering was disclosed in SEC filings, and each one meant more cash in the bank, but also fewer reasons for existing shareholders to celebrate. With every new share issued, the value of each old one slipped further from its meme-fueled highs. Wall Street hedge funds moved quickly to profit from the frenzy. Mudrick Capital, already known for its appetite for distressed assets, agreed to buy a massive block of AMC's newly created preferred equity units, known as APE units, at $7.50 each in August 2022. Within 48 hours of receiving 99 million APE units, Mudrick flipped the entire stake at prices near $9, pocketing a $36 million gain almost overnight. For AMC, the APE structure was a lifeline, a legal workaround that let the company issue hundreds of millions of new units without shareholder approval. For retail investors, it was a turning point. The rush of new equity diluted their stakes, and the combined price of AMC and APE units dropped by nearly a third in the weeks after the dividend. By the end of summer 2022, AMC had raised nearly $2 billion in fresh capital since the meme rally began. But every dollar came with a cost. The company's share count had ballooned, and the promise of easy riches for retail apes was now tangled with the reality of dilution and institutional profit-taking. The cash kept AMC afloat, but the trade-off was clear. Survival for the business came at the expense of those who believed they were saving it. In August 2023, AMC shareholders approved the conversion of every outstanding APE unit into common shares. The move was followed by a 1-for-10 reverse stock split, shrinking the number of shares on paper but leaving each investor with a fraction of their former stake. Overnight, the company's share count was reset, but the underlying reality was unchanged. Billions in new stock had already entered the market, and the value of each share had been relentlessly diluted. The financial engineering did not stop there. Over the next 2 years, AMC returned to the market again and again, raising more than $800 million through at-the-market offerings and direct placements. Each round brought in much-needed cash, but at ever lower prices. The share count climbed steadily, reaching over 210 million by late 2025.
For retail investors who had once made up the majority of AMC's ownership, the effect was stark. Their collective stake, which had peaked near 80% during the height of the meme rally, fell below 35% after the conversion and continued to slide as institutional funds and arbitrage traders took larger positions. What began as a community-driven rescue had become a corporate reset. The ownership structure that once defined AMC's new era was gone, replaced by a cap table dominated by dilution and institutional control. The company survived, but the identity of its shareholder base and the promise that fueled its meteoric rise would not return.
Even now, AMC trades at a fraction of its former value, while retail investors remain a dominant force in volatile markets. The story is not just about a fallen movie giant, it is a caution for anyone navigating hype-driven investing. In a world where memes can move billions, the line between opportunity and risk is thinner than ever. What happens next depends on how we learn from the mania. Share your thoughts below.